Welcome to the Daily Update. This is being prepared Wednesday, November 2nd, where we'll look at the action in the market today and then see how things look for Thursday, November 3rd. This is the first full-length video I've done in a few days. Things were pretty quiet earlier in the week until the announcement came out. And if you could have asked for exactly the wrong thing to happen at the press conference, it happened. The market had been looking a lot more positive. The markets felt like they kind of understood what was happening. And when they made the announcement of the rate hike, that wasn't necessarily a surprise. But then Chairperson Powell came out and made some statements that spooked the markets. And that has really switched things back over to negative. We have to see, where do we go from here? Was that an overreaction? Will the market bounce from this? As I've said in other videos, after we have these real gyrations, usually the market will revert back to the trend that it was in before the market started gyrating. Well, we were looking more positive, but that's more short intermediate term. But longer term, we're still in a downtrend. But in an even longer term, with our weekly charts, when you look at the 200-week moving average, we're still in an uptrend or a bullish long-term secular market. So which one do you want to pick? We're kind of teetering back and forth in different time frames, so it's really hard to get some confirmation. So let's go back and talk about what happened. It was a pretty quiet open. We did open lower down to S1 at 38.29. That's pretty common. When you have the FOMC going to make an announcement, there's a opening gyration, prices settle down, become very subdued until the announcement comes out at 2 p.m. Eastern time. Then when the announcement came, prices initially shot higher because it was what the market was expecting. They made their 75 basis point move. The statement that was released at that time, the market took as more or less positive. Well, then the press conference started and prices really started to go much lower. We closed at the low for the day, and we were down 2.5% on above average volume. And our technicals, they're slanting more negative now. We're losing a lot of that positive bias that we had been seeing starting to build. And there's still some positive things right now, like all of our oscillators are still positive. But as far as our moving averages, as far as price movement, as far as some of the other indicators, you can say one thing: we worked off that short-term overbought situation. So yeah, we really did that. But we'll go through and look at the different charts and then try to evaluate where things are at because of inflation and interest rates. And then the Fed speak. And I changed that over to dark or bold gold right now because we might get some more. And it might be positive, it might be negative. There might be some confirmation of what was said. There might be some walkbacks from what was said. So we'll have to see. I also have a new one at the bottom: Iran and Saudi Arabia. Apparently, they're not getting along and playing very well together. And there's been talk that Iran may attack Saudi Arabia. Well, it's not like the U.S. and Saudi Arabia are getting along all that well these days, even though historically we've been more friendly to each other. But what's that going to do if that escalates? What's the U.S. going to do? It's not like Saudi is part of NATO, and so that would be more of a unilateral type intervention if the U.S. ends up getting involved in something like that. Or is Iran really going to do something? You know, there's a lot of talk. It's not like we've been real friendly with Iran for a long time. Back in 1979, when they took over the embassy and held everybody hostage, you had a lot of real shifting in American culture over to Iran, which had been more friendly because we bought a lot of oil from them, over to basically there's been a declaration, a fatwa, I guess you would say, that do they use those in Iranian Islam? I'm not sure. But when the Ayatollah came back, they basically declared war on America, and we've been having trouble ever since. They kind of come and go from the geopolitical picture. There's a lot of really cultural things happening, especially with the female population in Iran right now. And what's that going to do? So we have to add another thing to our list of things just to be aware of. All right. So some comments. After the announcement, stocks initially advanced. Looked like, okay, we know what's going on here. It's what we expected. So we're going to take things higher, but then declined sharply during the Powell press conference when he said, it is very premature to be thinking about pausing. Now, that just was like a knife in the back to the markets. They thought that after that, those articles, or especially that one article came out in the Wall Street Journal saying that they're going to raise rates like they did, and then possibly not raise them as much in December. That kind of goes against what the market had been really anticipating will happen with the Fed, and then to also come out and say there is more ground to cover. So it's almost like the markets develop these scenarios, whether they come from fact or just try to read secret things into the market. And then specifically, Chairperson Powell comes out and just extinguishes that right away. Now, they're an independent body, and he's in charge of the Fed. And so he can say what he thinks are the right things, but they're not necessarily market friendly. It hasn't been that way in 2022. And the VIX is still oversold. With the decline that we saw, the VIX barely moved, and I'll show you that chart. The Dow lost its 200-day simple moving average. I'd been pointing that out in the daily brief videos that the Dow had been able to get back above the 200-day. Well, that's a memory now, at least for the time being. Some support has been broken, and I kind of have to show you on a chart-by-chart basis. Well, there's other support that's still holding up, but a lot of the short-term support that we were counting on that was looking to help improve the situation, that's pretty much gone now. But our longer term support, that's still hanging in there, but are we going to lose that too? Interest rates did rise. And then the scenario that I just talked about with the Fed possibly not raising rates as much in December, that pretty much has been ruined now. We're going to have to come up with some other kind of a potential pivot for the market to work off of. And that's why we want to keep an eye on some Fed speak, specifically from Chairperson Powell, to see if anything is floated out there to try to help the markets get a little bit more under control. Or maybe people will just sit back and say, wow, man, we just really tanked after that. Let's kind of fall back and regroup and maybe go back and buy some more and push prices back up. We still have all the yield curves that I follow, the 10 to the 5, the 10 to the 2, the 10 to the 3 month, which was the last holdout, and the 30 to the 5. Those yield curves remain inverted. Sentiment is now back to neutral. We were tipping more over into the positive side until Wednesday's session. And then we had, in addition to this, the mortgage applications index. It was down 0.5%. The last time we got this report, it was up 1.7%. So we're seeing some continued weakness in the housing market. And this came in a lot stronger than expected, where the ADP employment change, the number of jobs was at 239,000. They expected it to be 198,000. Now, this is a prelude to the report coming out on Friday, where we'll get the number that the market kind of takes as more the official number and see how things go. But that's what the Fed is citing a lot. It's like, okay, yeah, we know the economy is really slowing down, and in some areas it's not doing very well at all. But the employment situation there's an imbalance right now. There's more jobs out there than people that want them. And that's not usually what happens when we have a recession. That's not usually what happens when we start lowering interest rates. And so there's like these different scenarios going on that oppose each other. And then another thing is our ADX, it switched back to negative. There was enough of a down move because we saw Monday, Tuesday being down, Wednesday was really down, and that switched the ADX back to negative with the red line on top. But it's still weakening. We're just barely above 20 right now. So we could drop below 20 pretty easily at this point. And I've switched our bias to negative because we were down 2.5%. My goodness. And now I kept our momentum at mixed to a negative slant. Yeah, we've switched more negative, but when you have these kinds of things happen and the market reacted the way it did, and that there's the possibility of an overreaction, well, we might get some kind of a bounce from that, and we're showing some extreme negative readings as far as what happened in Wednesday's session that may produce some kind of a bounce. Well, what kind of bounce is that going to be? Could that switch things back to looking more positive again? Then, just to update this silly indicator that really has nothing to do with anything, it's going to be interesting if this plays out and St. Louis ends up winning, and then the economy goes in the toilet even worse than it already has. But right now, after the latest game, the series is tied at 2 apiece. All right, let's go back and talk about the session. Here we are back in the neutral area for sentiment and how we were showing some improvement, but we've been falling back down recently, still just a little bit above 50. Looking at some Isabel net charts, and I have some extra ones because I didn't do videos there for a couple of days, where you have the discretionary. These are the folks that can pick and choose what kind of investments they want. That's not like the discretionary sector. Okay, those are the same word, just a different meaning, versus a systematic approach where we have our plan. This is what we do no matter what's happening in the markets. Well, the discretionary investors, they're down, but they're doing better. And you'll find that in down markets where a lot of times folks, especially professional money managers, they tend to do better. A lot of times with the mutual funds, when we're having difficult times, the actively managed mutual funds will typically do better or perform less bad than some of the passive types of mutual funds, the ones that are attached to the S&P 500 or the Dow or some kind of sector where you're not picking and choosing the stocks. You're actually just going with an index at that point. And that's the blue line down here, or more indicative of that, where you use a system and it doesn't change no matter what's happening in the markets. Another one, this is also outdated a bit because now this 75 basis point that's grayed out, that's for real now. And then going forward, this is what they're anticipating, at least according to this. This is Goldman Sachs. Yeah, they're still projecting a 75 basis point move. It hadn't really clicked over into, well, I guess in December they had kind of clicked over. I don't know why there's 2 boxes here for November, but they had kind of thought that they would not raise rates as much as they have. All right. And then we have, and this is a couple of days old, this is the Ridex bear bull ratio. As we were going up, folks are getting more out of the bearish funds, which they really wish they were in on Wednesday. So we'll probably see this spike back up as folks tend to react to what's already happened. Then this is just showing the monthly seasonality with the second year of the presidential cycle going back to 1928. And if you look over here on the right-hand side, things do look to be more positive. We do have history on our side. We've got seasonality on our side, but we didn't have Wednesday on our side if you want the market to go up. Then this is also kind of interesting where people are still putting most of their money into tech. It's like, I guess, buy low and buy lower and then buy even lower than that. But most money is still going into the tech sector where you have the financials at the bottom, which have been showing a lot of improvement, but they're starting to turn up and they're gaining some ground. The sector is showing some improvement. And so you have some folks that are starting to get into those things. Then this is just an interesting chart where it shows the top mega caps as a percent of the S&P 500. It's 31.82%. This is the Microsoft, the Google, the Apple, the Amazon, all the big companies. And then the rest of it is the 68.18%, just kind of a breakdown. And this is a weighted average. And I cover this in my class. And that's why if some of the big boys are having a really good or bad day, and you're going, wait a minute, why is the S&P acting the way it is? That's because the big stocks have more of an influence than the smaller stocks. Then we have crude oil forecasts. Well, looking forward, and this is the one that I follow, the WTI. That's the one where we look at the chart there. They do expect oil prices to increase some more. And then you have Brent C crude. I look at that, but I don't follow it as much. I follow the light blue line, excuse me, the dark blue line a lot more, where they're expecting it to get back up to about $100. And this is Bank of America's forecast before it then starts coming down. And then again, this is old now, but this is what they were expecting the Fed fund futures to be. Here we're coming through October, and they expected it to be up at 4.8%, possibly topping out, or the terminal rate just under 5% before heading lower. And then you can see where we were a week ago. Now, this is going to have to all be revised now, not because of what the Fed did, but because of what the Fed said in there. Now, there's another chart. I do look at this myself. It's called an equal weight index. You remember where I just mentioned that the S&P is a weighted index? So the big companies have more of an influence than the smaller companies. Well, they also have an equal weighted index where every stock is treated the same. And this is relative to the S&P 500. I look at that chart, but I don't necessarily think it's giving us all that much insight. So I haven't been including that in the videos. If you want me to include that, I certainly can. I have 2 or 3 or 4 different charts comparing the S&P with the equal weight S&P. But again, this is a little old now. This is just showing how the equal weight index has really been outperforming the S&P 500. Not so much after Wednesday's session. Here we talk about equity positioning, where we still have folks that are zero here. Just shows that there's not a lot of people in the equity positions right now. Then China has really been having some trouble now. And it says they have a Golden Dragon China index, and it's at a 9-year low currently. And then this is the largest inflow in emerging markets. Some people really like emerging markets. It gives them international exposure, but they just haven't been performing very well. But there's still a lot of money going into mutual funds or ETFs that focus more on emerging markets. Then this is the ISM manufacturing, which came out earlier in the week. It shows that's the gold line here, how it has been declining with the S&P 500. And these two tend to go more hand in hand with each other. Then this kind of a really funky chart here. It says U.S. stocks are oversold. That's on a very long-term basis. Do you remember, if you've watched some of the other full-length videos, I've been showing some really long-term indicators like a 200-day, 250-day rate of change, and they were getting down to the COVID lows and starting to turn back up. That is suggesting that, and some other indicators are telling us that on a long-term basis, stocks continue to be oversold, but the earnings per share expectations are not downbeat. This just kind of what they concluded here is, given macro headwinds, the problems that we're having, S&P 500 will likely drop to 3,200. Now, this chart came out before Wednesday's session and says stocks were oversold for 9 months back in 2008 during the financial crisis. We also saw a real drop in the EPS revisions. Well, they're still going down here too. And earnings are ultimately what drives stock prices. So if they're going down, that can produce a lot more headwinds for stocks. We're just showing the equity allocation. Still, most people are in stocks, according to this chart, at 61% currently of the assets under management for Bank of America. And then these are aggregate U.S. equity futures positioning. They still are net short. When they drop below this line, instead of being long in the futures, they are now net short. Now, some of those could be used for hedging. If you want to hedge stocks that you hope are going up, what you do is go short in a futures contract so that you can replace anything that's lost. But this has been going on now for pretty much, well, since the spring, that they're still net short overall. There's another market sentiment indicator that we see sometimes. it just shows that sentiment was improving. Now it's probably dropped back down, but before Wednesday's session, it was looking better. And then buybacks, which this is kind of contradictory. This shows how buybacks have been dropping off now, but we've been watching some other charts from Isabel Net showing that buybacks are really going up. So we're seeing some contradictory information there. But the interesting part of this chart is where they have the dashed box for the third quarter of 2022, where they're not buying back stock currently. And that's tends to be more positive, because when a company goes out and buys back its own stock, that takes some of the shares off the market, which can help bump up the price. And the fact that the company likes its own stock, that also gives it another vote of confidence. Then, speaking of confidence, CEO confidence is pretty low as of October 1st. Now, this is outdated a bit. CEOs were just not feeling very good about things. It can go lower than it is right now, but we can, when it gets extreme like this, use this as a contrary indicator. So now let's go back and talk about the day. Look, we just see red all across the board, with growth over on the right-hand side just getting hammered. But the VIX barely moved. And please forgive my scratchy voice. I can't seem to get rid of that. See where we, on a closing basis, we're pretty much sideways, even on the bar chart. I mean, just, you would think with a 2.5% decline that this thing would have moved more than it did. And that's why we're still oversold right now. And the VIX of the VIX is still, even though it ticked up slightly with the down day, we're still getting a pretty extreme reading. And here's where I show the RSI 9 period, where we just haven't really moved. We're still extreme negative because stocks had been going up. We're going to have to keep an eye on the VIX to see if that readjusts. Ulcer index turned up a little bit with the down day because that's an increase in fear. We're down 21.98% from the all-time high. And the equity put call ratio, man, it just spiked up. As we were going down, folks were just jumping into puts like crazy. And the 5-period simple moving average. Now, we're still working off of this spike that we had near the end of September. Are we going to come back in and take that spike out and generate a new signal? Yeah, just something to be aware of. And these charts, this chart and the daily chart, have been posted on the YouTube community page. I try to do that even when I just do a daily brief video. So there's one day I forgot to do that, but some folks really rely on these pivot points intraday. And so I like to put those on the community tab. And I apologize for the folks that use Rumble, because I just don't have a way to post files like that. Here's the daily chart where we were looking a lot better. We were getting above the 50-period moving average. Boom. But notice right where we stopped. We stopped right at the pivot point. That ended up being support for right now. Are we going to be able to bounce up off of that, or are we going to continue to fall down below it? And we also saw an increase in volume. The short-term fib levels, these had been holding up. This is that double fib level that I've been talking about. Well, we broke through that now. The next level is down around, and I can't read that number, but would be the 38.2% retracement, and we're still above that currently. Longer term, this is another double fib level that was holding up. Well, we now close down below that. But weekly, much longer term, even though we fell back below the 38.2% retracement, we're still above the moving average, and we still have a ways to go. So even though we broke through this support, probably the moving average is more important, because that's what really kicked the market into gear when we got down to this level. We want to keep an eye on that, and that's at 36.19 currently. We've dropped a little bit to the underside of our trend channel. The sectors, every one of them was negative, led by discretionary, tech, communication, but take your pick. They were all down, with utilities and financials being down the least. And then as far as our scooter technical analysis scores, energy, healthcare, they're still in the 90s as far as how their charts are looking. where we have communication down here at 4.7 in single digits. And this goes back to the all-time high, showing how energy is up 54.59%. And followed by utilities, they've jumped back into second place, and then healthcare is in third place. And then you have communication, discretionary, and tech, and then real estate being down the most. And this is the indexes and how they performed since the all-time high in the S&P, which is the pink one. Our technical alerts had a few positive and then negative, where the NYSE had a BPI across 50. That's positive. And let's see, I'm not seeing where it crossed back below that. And then we had the industrial sector. It came below 80. That's an official overbought reading. Where the healthcare, it crossed above 70. That's more positive. The NASDAQ went below 10.8, then got above 10.9, then went way down to 10.6. Up here, the S&P broke through 3,800. And then materials also had a BPI cross. This is negative. We were seeing a lot more negative or positive things when I did the last full-length video. Well, a lot of those things are turning more negative currently. Can we get that positive edge back? And then the Dow, even though it's still in the 90s, it's kind of flat, but it's been weakening a little bit. That's still the best looking chart. And in a very distant second place are the small caps, followed by the mid caps. And then in fourth place is the S&P, which was looking better, but not now. And then really looking bad are the Qs. They've really been, we needed some real explosive upward movement from the NASDAQ and the NASDAQ 100, and that just wasn't happening. All right, intraday. So we gapped lower, came down to S1. We actually broke a little bit below S1, but things stayed pretty quiet because everyone knew that the announcement was coming out. Right when they made the announcement, we shot up, and it's like, are we going to go higher? We're going to go higher. Then Chairperson Powell started to talk, and then everything just talk about ruining a party. My goodness. Don't invite him for Thanksgiving. All right. And then here's a 1 minute chart, which I like to bring up and watch, where we saw the initial positive reaction, then a whole lot of indecisiveness, and then a whole lot of downward movement and closing right at the low. Here's the other chart that's on the community tab, just showing how we've come down to the pivot. It's interesting how that's right where we ended. Our ADX, as I stated earlier, the red line is now crossed above the green line. It's a little hard to tell because the green line is going down, but we're at 20.13 with the ADX right now. If we continue to fall, we'll drop below 20, and then we'll be in a trendless environment where not much of a real change with our rune, because we just kind of bounced down to prices we were at just not so long ago. Looking at breadth after it had been showing some real improvement, but look at this downward thrust, both based on price and volume, which turned everything lower. The advanced decline ratio, which had been just a little bit extreme positive, is now dropped back. New highs, new lows. Because we were in this recent area not so long ago, we saw a breakout of new highs, and then when we were going lower, we did not see a breakout in new lows. So that's internally, that's helped this, and this could be positive for right now. Accumulation distribution, showing how we really declined overall. So that's negative. Short term, our advanced decline ratio, yeah, we had a powerful down day, so we may have overdone it. And looking at the 20 period, we were leaving that in the rearview mirror, but now we're right back down to the 20 period exponential moving average. The simple, the red one here, that's the more important one. That's at 37, 30, 31-ish. So that could be another support level if we continue to fall. And then here's our short-term rainbow, where we were up on the coming out, looking at clear skies. Well, we've been dropping back down into the rainbow after Wednesday's session. Rate of change going back from Tuesday to Wednesday also suggests that we may have overdone it. The Stochc RSI, which had been overbought, no, not that way now. Same thing with the Williams percent R. And the force index, which it became a little extreme last week, but it's now dropped more negative. Swindling Trading Oscillator. This overbought has been worked off now, and we also are declining more with volume. McClellan Oscillator, another one that was giving us a pretty extreme positive reading. Don't have to worry about that now. 20 period, 50, and 200 period moving average. We were looking extreme with the 20, but now we've turned down across the board. Stochastic, we were also getting more overbought. We're down. We've worn that off in the short term. We're coming off of that in the intermediate term, and we're rolling over a bit, but now we're still looking kind of extreme positive in the longer term stochastic. Intermediate term, here's the 50 period moving average, which we were able to get back above that. Nope, not happening now. We sliced through that quickly. 100 period, which had been acting as resistance, well, now we've come back down to the pivot level. And here's our intermediate term rainbow. We were starting to come up into the underside of that, only to get knocked back down. Here's our moving average tree, just showing all the different moving averages together. The Sean trend meter turned down, looking more negative currently. The PMO, see, our oscillators, it takes longer for them to shift. So the PMO, even though it's rolling over, is still positive. Our PMO study, this had been looking extreme positive, not now. The buy signals still looking kind of extreme positive. It's rolled over and declined a little bit, but hasn't really worn all of that off. We're still looking okay with the percent of PMOs that are above zero. Chaikin oscillator declining. Chaikin money flow declining. Volume picked up on a down day. The vortex, this is still positive, even though it's showing some weakness. The green line is still on top. The summation index, because the McClellan oscillator is still above zero, this will continue to advance. So we're still going up based on price and volume. So there's things that can be salvaged here. It's just we're going to have to see what kind of follow through is going to happen. But here's all of our oscillators. Even though they're rolling over a bit, they're still all positive. The BPI didn't go down as much as you would think it would, because we're back to prices that we were visiting not very long ago. Ease of movement turned down, but is still above the midpoint. Ultimate oscillator, this is more negative. It's declining below the midpoint, where the money flow continues to, or has started to decline. This is another area. This was more intermediate term. The CCI 14 and the CCI 20, they're no longer overbought. TTM squeeze coming up with a darker blue. That's more negative, but we're still positive overall with this indicator. Balance of power saw some decrease in its value, but it's still above the dashed line or the midpoint. And then the CMB composite, it's actually generated a sell signal that'll be confirmed if we continue to fall. This indicator was kind of interesting because it topped out and started to go down before price did, but this can also lead us astray sometimes. This is kind of another big one where we got back to the anchored moving average, going back to the COVID low, and we were above that. Nope, can't say that anymore. Turning more negative with our Heiken Ashi, dark candle. Still looking positive, but going down with the Kegi. The Renko hasn't redrawn yet. The three-line break has not redrawn yet. We're still working off a bearish signal reversed on the point and figure chart, but nothing new has been drawn in because we're just back down to where we were. We have switched over to negative with the S&P 500, with the Elder Impulse, and with the SPY. We're still positive with the SAR, the stop and reverse system. And we've gone to a no-go right now that we're switching back to after it had given us a positive signal. Well, after Wednesday's action, it's like, wait, hold on, don't do that. Long term, seeing some declining with our 50, 150, and 200-day moving average study. This is the longer term chart where we had been oversold for quite a while, and we rolled back over a little bit, but we're still below, or excuse me, still above this extreme negative line. Special K continues to advance, and 250 periods also. This really has rolled back over, and it's starting to go back down again. And our diamonds are back to neutral. The Dow, after getting above its 200-day moving average, now has closed below that. The Qs have switched back to negative. They never really enjoyed this positive scenario that was developing. They The NASDAQ and the NASDAQ 100 just wasn't part of that. And here's the NASDAQ 100, which has now dropped below the monthly pivot. And I don't know. I get a lot of crazy data with this thing. So I have to look at the line chart where, for as much as we were down, you would think that this would have really spiked up with the Vixen, but it didn't. Here's the NASDAQ, again, showing how it's dropped below the pivot, never did get back to its 50-period moving average. The mid caps still holding up above the 50-period moving average and still above the pivot level. And the Wilshire right down to its pivot level after breaking back down below the 50-period. All right, the dollar down just a little bit, still in an overall uptrend. And then the S&P to the dollar, it's kind of getting back more towards neutral, but still having a tendency to go in opposite directions. Gold, it was down too, and in a downtrend. Same thing with silver, even though it's still above the 50-period moving average, but it's a declining trend. Oil bounced back up to 90. And the correlation between the S&P and oil, well, it's working its way back down to neutral. Looking at bonds, they were down slightly with our total bond ETF based on price. Also declined about 1/3% with our world bond index. And then our yield curves, all of these are inverted. The 10 to the 5, the 30 to the 5, 10 to the 2, 10 to the 3 month. And then the 10-year yield, after it really had gone back up, it was coming back down. That was giving some support to stocks, but not on Friday. They both went up. But we're right at 4.059% for the 10-year yield. And we're coming off of that reading slightly. The 30-year yield, after getting up to 4.4%, is now backed off to 4.15%. And we're still seeing the 2-year yield way in the lead and climbing, where these other lines continue to cross over each other. And stocks to bonds still having kind of a tendency to go in the same direction. S&P to the 2-year, slight tendency to go in opposite directions. S&P to the 10-year, going in opposite direction, basically, but not a real strong reading currently. And then tech to the 10-year, it had been neutral. Well, now it's starting to look like they could be headed in opposite directions. Our scenarios, these took a hit. Now, this one was actually getting a little extreme positive based on price. It has now backed off. This is still a valid signal currently. Volume, it never did get extreme, but it's also backed off. Those stocks above their 200-day moving average, this really didn't move all that much because this takes a lot longer to recalculate, but it has been showing some weakness with the down days that we've seen this week. This has declined a little bit more with the S&P stocks above their 50-period moving average, as well as with the mid caps, that has declined, and the small caps. And this is another thing. This has actually been increasing slightly. The 10-day average of the S&P highs and lows, this is still holding up. And then broad market, we're actually showing some improvement here, even though we continue to be negative. The equity put call ratio, the longer term version, see, we're still working off of this spike, but we're starting to creep back up with this reading. Is that going to generate a new spike if it continues to go up? Small caps, man, they had really been doing well. Well, down 3.41% in Wednesday's session, but still above the 50-period moving average and the pivot point. And even though they were down, they have been outperforming the S&P 500. So we're getting a little bit of a spike in our red chart, which sometimes can give us some support for the blue chart, which is the S&P. This is really breaking down here. The Qs, they've actually gone and made a new low. Discretionary against the S&P is declining. Large cap growth against large cap value, it's also breaking down to a new low. This could still recover at some point, but it's not giving us the confidence that it had been earlier, where we're just seeing pretty much across the board declines. And we saw a bit of a decline with our S&P to utilities ratio, but it's still having a tendency to go up. 2-year, we don't know. I mean, this thing just keeps going to the moon, so we don't know when we're going to spike with that. Staples were down, but not as much as the S&P. So we're starting to spike up a little bit on our ratio, but we still have not taken out that previous spike. Copic curve still have a signal here, but it's starting to weaken. Spring bottom fisher, this could probably cross in the next day or so, which means that signal is over. That's pretty much all it would do at this point. We can still look to other things to tell us what may happen. So what's our outlook for Thursday? The technicals, yeah, you got to say it. They're turning back negative. We have jobless claims coming out, the trade balance, the preliminary third quarter productivity, as well as the unit labor costs coming out, factory orders, and then probably the big one is the ISM non-manufacturing. The chart that I showed you at the beginning of the video, that was the ISM manufacturing. So we're going to get that report coming out. The whole list of geopolitical events, you've got a market that's now confused again. We're going to see if any more Fed speak comes out. I've added Iran and Saudi Arabia to our list. We still have the midterm election coming up next week. There's still some talk about stagflation, where we get really high inflation without the economic growth. That is a concern to some folks. So I didn't really know what to do here. We could go with the down scenario because things are switching back more negative, but there's still some positive things to look at. So I just turned both of them gold for right now, but we did see a real weakening technically with our positive scenario. And then if we end up dropping below 20 with the ADX, then this is probably going to be what will come up. So the down scenario may go away quickly, the up scenario may go away, and we may go into a sideways trend, at least for a few days. So our conclusion, the S&P is turning back negative, short-term negative, intermediate term, turning negative, long-term, it still was negative. Some of the improvements that we were seeing, not happening with as much conviction as they were. So thank you. Have a wonderful Thursday. I'll look at the market action for Thursday's session and then decide, will I do a video for Friday's session? So good luck with all of that. And it's probably a little discouraging because it looked like things were turning a little bit more positive, but leave it up to Chairperson Powell to rain on our parade.